Hey, how are you doing, guys? Uh, so here we are with a brand new topic, a very important one at that, trading plan. Why should you have a trading plan? It's a very important subject, and I would like to talk about it and give you my feelers about why it is so important when you have a trading journey. Uh, you know, so I have a tagline: plan the trade, know your exits, and always respect them. A trading plan has a lot of things to discuss and talk about, but right at the start, I want to make it very clear that in my trading plan, the most important thing that I want to stress upon in today's video is exits are always very important. And by exits, I mean the one that you make for your profits is also important. The most important is the one that you make for your stops. Most of the retail traders are not very disciplined about their trading, and they forget to put they don't forget, they basically are aware that the stops need to be put, but because of the fear of losing out, they don't use the stops, and that's the worst thing that anyone can do. So let's kickstart this trading plan journey. uh, let's go. So, a little introduction about me. I'm Manoj Maheshwari. I run a channel called Market Ideas for Profit. What we do is, I have been a technical analyst for a very long time. I've been training, and I'm probably the eighth year. And when I started to, learn technical analysis, and it's been an 8-year journey. It's been with a lot of ups and downs, with a lot of learning. It's come the hard way, and to give you the right perspective, becoming a technical analyst will always take you time. It's like a mango, it takes time to ripe, right? So this is similar. I mean, more, not more like a mango, but like a wine. The more you ripe, the more you get better at this. So the years count in this field. The years really count in this field. So I've gone through a number of subjects. I have read about a lot of things. I've seen a lot of things. I have had personal experience in trading, and that's about it. So I would say I'm 50% all the way through in my journey, and there's a lots more to learn. But I think I've reached a stage where I can share things with people who are just starting out, or maybe somewhere down the line, and that could help them speed up the process. So this exercise is to give back what I probably have learned, and to save a lot of time that you would take to get there. So let's get cracking on this subject. Welcome back. So what I'm going to try to do here is to establish a need for why you need a trading plan, and you need to start your trading journey with choosing a broker. What are the things that you need to do about when you choose a broker? How do you allocate your funds? What are position sizes? What is risk management? And finally, what is journal reporting? So this will form the crux of all that we will be discussing today. So, need for a trading plan. Why do you need a trading plan? Well, every business, every activity that we do in our life would go better off if we have some plan to go about it. So, like taking a journey, you say if you want to visit somebody, and if he's out of town, you would have to plan what date you will go. You'll have to plan what flight you will take to get there. You'll have to plan who will take you from the airport to where you need to go. You'll basically have to plan everything. And like every activity, trading is a very, very it's something that really needs a lot of planning. So unless you understand and plan it, you're not going to get anywhere. So it's like when you start your trading journey, it's best that you have a trading plan in place. If you don't have a trading plan, you will be going around and not taking the best decisions to get to where you want to be. Planning takes a lot of research. So once you start your trading, you should research what you want to do before you start to trade. And so that will involve trading which asset you want to trade. It would involve how much money you want to risk. It'll involve what kind of strategies you want to take. It'll also have to be meaningful. It will not be meaningful unless you set a target for yourself as to what do you want to achieve by trading. So the end goal of any activity has to be addressed right in the beginning. Unless you address that, you are probably not going the right. You're going without any direction in mind. So that's what it is. I think that is that. With this slide, I will have established that yes, trading needs to be planned. So let's now dive deep as to how are you going to go about its activity in the next one. So, need for a proper broker. So what should we look for when we choose a broker through which our trades are going to go to the exchange? The broker is the person, is the person, is the entity or the platform through which we communicate our trades to the exchange. The broker should have various asset classes to trade with. The current trend is to trade with online brokers, so that goes without saying. You need to have access to put in your own trades through the system. It's archaic to think that you can call and put up a trade, to a broker, because things are very simple now. And like you send a WhatsApp message, you can probably send a trade to the exchange through the broker. The broker terminals are very user friendly these days. So what your broker should be able to give you that online access. He should help you trade in equities, commodities, futures and options, forex, cryptos. All these asset classes should be possible for your broker to provide you to when you want to trade. The brokerage cost should be reasonable. It may not be zero, but it should be minimal, and it should be market competitive, because when you trade, the number of trades are pretty high, and if the brokerage is not very very competitive, it can eat into your profits. The trading platform should be reliable and consistent, and it should have a good support system. It's all online, so it can fail, and if there are bugs in the system, it can fail at the point that you really need to execute a trade. So you should make sure and do some research and find out through the referrals that the portals have, that it's a very consistent platform to deal with. I've had these issues initially and had to grapple with a few brokers, and then had to change brokers. So you have to be very sure that you have a right platform to trade on. The back office support and the reports that get generated should be very clear and clean, and give you the correct picture of what's happening with your trades on a regular basis. They should have a sound financial backing. They should be in the market for a long time, and they should not be having, because you trust your money with them. And if you put your money and your stock remains in their demat, and if they get into trouble, and if they cannot, if they use the funds and the resources that you place with them irresponsibly, you could land in trouble. So you should make sure that they have a sound financial backing. Again, online reviews will help you on that. We have a few brokers that I have been dealing with, and I can suggest you those two brokers. They're reliable. They've been in this for a long time. They have a competitive market scenario. I'm not going to say that they're not going to fail in terms of their consistency, but the consistency is 98%. Now that's pretty big. 98%, 99%, 95% is a very good rate of consistency, because when you run on software, glitches can happen and you have to live with them. But I am enclosing a link of these two brokers who I trade with, and you can join and become members through this link. And that's it. On the brokers, you can get started right away with these links. You can set up an account online. Doesn't take some time. It takes about 5 minutes, and all your documents are ready. You can just upload them. You don't need to visit anybody. You can upload your documents online, and within a day or two, you could start to trade. That's it. If you've not begun your journey, take this step and open an account, and let's begin our trading journey. We're well on our way with choosing a broker as the first step that you take to start your trading journey. I hope I have given you all the topics on this subject, and let's move on to the next one. Hey there, the next important topic that we need to discuss is allocating your funds. Now, allocating your funds means you have an X amount of money that you can earmark to invest as an investment. What is the investable surplus? Investable surplus is after having taken care of all your regular needs. If you have some money that is lying around which you need to allocate to your future requirements, or something that you save which is over and above the surplus that you need, over and above the expenditure that you incur every month, is the fund that we're looking at. Now, even within that fund, you need to allocate a major portion to your investments for a longer term, and a small portion should go towards your trading activity. That's the basic rule of thumb. You can't be trading with everything and not investing anything. That's the wrong way to go about using your surplus funds, because trading is a little risky business, and you cannot depend only on trading for all your surplus investments. So you need to bifurcate. So this bifurcation of funds between trading and investment will vary depending on your age, depending on the amount of money that you are putting aside, and depending on your plans and your targets to what you want to achieve with those funds in terms of how quickly do you want a corpus to come out of that activity. So it's good to be conservative and not expect too much out of your trading returns. Even if you can make 30% return every or 35%, I think that's a very decent return to make. Now people do aim for larger returns, but then aiming for larger returns is exposing yourself to more risk. So if I am say 35, I would allocate 30 to 40% of my money to trading, and I would carry 60 to 70% in my investment portfolio. As I get to 50, 55, I would restrict my trading activity to 20%, and 80% should go towards my investments. So as you get older, you need to become more conservative with your approach. You can be a little more dynamic and aggressive in the beginning of your career, but as you grow older, you need to restrict and reduce the amount of money that you put to your trading activity. But there's a different tone to that. If you start early, and if you have some experience of 10 years by the time you are 50, and you're very comfortable with your trading, and you're making consistent returns, your allocation could be a little higher. So this will vary from individual to individual. And here the financial planner and your financial consultant, who all of us should be having in any case. I'm not a financial consultant, I'm an educator, and I trade. I'm just sharing my views on how we should go about trading. And trading, the plan becomes a very important aspect of the trading journey. That's the reason I'm here to talk to you about this plan. But I'm not the person who's going to tell you what and when and what is the allocation that you need to do with your funds. That is the job of your financial advisor. Whoever you depend on, it's best to go with somebody who is doing it for a lot of people, and who has a grasp of the subject. So you should go to your financial advisor to get this allocation and understand how you should be allocating your funds. You should have a different account for your investments and a different account for your trading. You should not mix the both of them, because when you're trading activity, if you see a shortfall and if it's in the same account, you will probably use your investment fund towards the trading account, and that's not a very good discipline to have. That could hurt you in the long run, and that would give you more exposure than you would initially plan with your trading activity. So you should have two separate accounts. It's easier to track, it's easier for tax purposes. I would advise you to have separate account for trading and separate for an investment activity. Now, the other thing is what kind of targets you should have for your trading activity and your investments. So it comes with a lower allocation. Trading, you require a lower allocation for your trading plan, but the returns that it should generate should be 2x of what you would get from, say, a mutual fund, a fixed deposit, or something like that, where your investments are for a longer term. So your returns on your trading activity should be at least 2x. If they are not 2x, it doesn't make sense for you to get into that trading activity, because the trading involves acquiring a skill, giving it time, and taking risk. So unless it gives you a reward commensurate to all those things that you do, there's no point in getting into this activity. And like all of us know, trading is a short-term investment, and investment is a long-term investment. So these are the topics that we need to cover in allocation of funds. These are the things that you need to think about and decide before you allocate your funds. And once you allocate your funds, stick to those rules. You can re-look at them at some interval, but on a general rule, you should be disciplined and stick to what allocations you have made. I think we've spoken about this, and you get the grasp of it. Let's move on to the next one. Hey, the next topic, which again is a very important one that we need to discuss, is your position size. Now, what is position size? Position size helps you in identifying a suitable risk profile for each trade that you take. So as a thumb rule, the rule that I follow is that if I have an investable surplus of say 100, I will not get into any trade beyond a risk of 2% on each trade. So if I have a 100,000 rupee plan amount for trading, I'll make sure that 2,000 is the maximum risk I can take per trade. And how are you going to be able to achieve that? Well, it's not very difficult. I have attached a link to a position size calculator, and it is very easy to calculate your position size. Basically, if you look here, you will enter the total amount of money that you put to your trading account. You will allocate, you will put in the value of risk that you want to take in each trade in terms of percentages, and then you will say that you have decided that you will invest in this particular share. So you will write the price of that share here, and you will then get an idea as to what should be the first stop that you should put. Once you compute this, it will tell you the number of shares that you can take. It will tell you what is the position size in terms of money, what is the risk per share that you can take in terms of the value, and it will tell you the percentage of risk to position size, and that's all. It will give you all those details. So you can use this calculator and decide your position size. So as a thumb rule, it should not be more than 2% of your capital. It helps limit your losses per trade, and it also sets up an expectation that what you want to achieve from each trade. So it's a part of the planning process. When you get into a trade, you should know that there's enough play in that trade to give you a certain risk reward. What is the risk reward? Risk reward is the ratio between the risk that you take and the reward that you want to achieve. This is a very important thing that you need to understand. Say, I'll give you an example. Suppose you take 10 trades and you are 50% right and 50% wrong. So what is happening is that you're winning 5 and you're losing 5. Now if you take a risk reward of 1:1, in the end you will have lost 5 and won 5. So the activity would not have given you any result. So that's not a good way to plan your trade. So when you plan your trade, you should always allocate your risk as 1 and a minimum reward size of 2. So now let's rework on what we got the result. Now if you have 2 is your reward and 1 is your risk, so if you take 10 trades and you survive on 5 of them, or you do good on 5 of them, your loss will be 5 and your reward will be 10. So with that 50% success rate, you will achieve a 5% 5x gain. So you have a 5 rupee gain if you are working with a 10 rupee corpus. But if you take 1:1, you will end up with 0. So it's important to plan your trades in such a way the risk is always half of what your reward is as a minimum. It could be larger, but as a minimum, that should be your plan. So, but you need to plan this before. So the position size helps you in allocating funds. It helps you on the chart when you go do technical analysis to see if the chart gives you that move that your risk can be 1, your risk is 1 and your reward is more, is when you want to get into these kind of trades. Again, position size in cash and F&O equity or forex could be different. So again, you need to plan plan this right in the beginning. Until you have a big corpus, you should not go in for F&O trades. So you should stick to cash trades until you have built confidence and until you have some experience in the market and you are sure of your analysis and you start getting a better consistency on your success rate with your trade setups. So position size, I think I've covered a lot. I've covered into everything I wanted to say in this slide. You can go use this link, and to start with, you can use this calculator, and over a period of time, you won't need to calculate. But it's a good practice to have this calculator handy and keep on checking your position sizes. You can increase your position sizes as you become better at your trading activity. I guess that's what all successful traders do. Don't jump in and have a big position size. Start with a small one and scale it and reward yourself with better returns once you have proven to yourself that yes, your setups are working and your percentages to your percentage on your trade setups are doing good. So that's about it. We'll go to the next one after a bit. Hi there. It's time to talk about risk management. Like always, this too is a very important subject while you're trading. So you'll be wondering, I say it's important for every subject that I bring it up to you. But there are a number of things which are not important and they will not find a place in my slide if they are unimportant. So risk management is also another important aspect of your trading plan. Risk management involves a lot of psychology. We can have a set of rules, but then to follow those rules when you're live trading or when you're in a trade is a totally different ballgame. So I would rate your analysis just 30-40% of the entire plan, of the entire outcome, entire factor that results in your profitable outcome. 25-30% is trade analysis. Say about 20-30% is your discipline. Risk management plays about 15-20% of your entire ball game. Risk management involves sticking to your fund allocations, sticking to your position sizes, sticking to your risk, taking the stops that happen, and letting the trade flow to its ultimate fruition and not get out of the trade while it's looking green but not having reached its final probable destination or potential destination. These are all, risk management subjects, and there are tools to help you to manage your risk, like position size calculator is a risk management tool, trailing stop losses is a risk management tool, setting stop losses is a risk management tool. These are all risk management tools. Now, stop losses are the bane of every trader. In my initial years, I was not good at using my stop losses, and I used to feel that my conviction is so strong that my trade is going to eventually reach my end goal. So why should I put a stop loss? It'll do it sooner or later. But I'll give you an example here. What happens is, suppose you've gotten into a trade at an entry price of 100, your target is 105, and your initial risk stop, hard or soft, is 98. So you have a 2 rupee stop loss limit and a 5 rupee gain. That's it. 1:2.5 risk reward. Good. So far as you've gotten into the trade with that plan, so far it's so good. Now the market is, there are a lot of factors that play in the market. It could go wrong, and it would go to 98 before it goes to 105. And you would say that you would not want to stop out, but that's a wrong way to go. Go with it. I'll tell you why. If you place 98 as your stop loss, stick to that stop loss. Eventually, it may go to 105 and you may lose out on one trade or two. But look at a scenario where it goes down to 90 before it reaches 105. Now, if it goes down to 90, you will have taken a larger risk. So your risk reward position sizing calculator goes for a toss. You lose time because when it goes down to 90 and then goes to 105, you'll lose a lot of time on your trade. All of us have limited resources to trade with, so you'll eventually get that capital involved in that trade and you will not be able to use it for something else, and that would hurt you. So that 10 rupee loss is going to hurt you. And what happens is, psychology doesn't allow us to remain in that trade, because you see a new trade every time when you're in touch with the market, and you will get out of that trade and you'll jump into something else because you'll see the funds lying around without any movement, and eventually it will go to 105, but you will lose out. So a good plan would be to stop out at 98, and there could be two ways. When it goes to 90, you keep your conviction and enter at 90. That will give you a larger gap to play with. Or if it goes down to 95, let it go down to 95, let it jump back to 98 and see an upward trajectory, enter back at 98. So you don't lose anything. All that you've lost is your time, but that time is not lost, because at the end of the market is here every day. It's not going to go anywhere. So a stop loss has to be treated, it should not be treated like you've gone wrong on your strategy. You are not going to go wrong. There are so many things in the market that there are so many people playing it. There are so many factors. There's news around. Things can go wrong. There's nothing wrong with you having made an analysis and it going wrong. The best of the best traders with years of experience, 30, 40, 50 years, may not be having a more than 70% success rate on their trading setups. That's fine. They have to live with it. I achieve about 50 to 60%, sometimes 70%. In some months, I'm down to 30%, down to 40%. Some months, I'm as high as 75 to 80%. On an average, it's between 60 and 70%. So that's because based on my analysis. But then, like I told you, analysis plays only 25 to 30% or 40% on the entire game that we're playing as a trader. So having done the analysis also, if you don't manage your risk well, you can end up losing. So the essence of sticking to a stop loss is very important. I'm giving it more focus because I've been guilty of not doing it in the initial years, and I've paid the price. But that's the way it is. You fall and then you learn. But it's better not to fall or not have a very hard fall that you break a limb. So sticking to your plan, sticking to your risk management, goes a long way in you getting to your journey, getting to your targets earlier in your journey. I'm not going to say that it's going to be easy, but it'll help you get to your journey quicker. So risk management, have a lot of focus on it, and that's the way you manage it. If you start using more trades, you'll have to be short and long. If you do futures and options, you'll have to look at hedges. If you are looking at an investment portfolio, you diversify your investments. by placing your money in different sectors, because each sector is a cycle life, and sometimes there are sectors that are, have a positive correlation, there are certain sectors that have a negative correlation. So you have to look at all that when you decide to take your trades. Risk management is a wide subject. I cannot do justice to it by covering it in the short webinar or plan that I'm presenting to you. What I'm trying to do here is highlight to you what are the things that you need to look at. A further research will always be needed, and even I could be coming out with a more detailed video on each aspect of the risk management in the future. But right now we're in a trading plan subject, and risk management is a very important thing that you should look at. I guess I've done all that I wanted to say. There's more to say, but can't be more detailed about it. So let's hop on to the next one. Hey there. One of the last topics that we need to discuss today in this subject of trading your plan, planning your trade, is the journal bookkeeping. Journal bookkeeping means it's a log of all the trades that you take in your trading journey. So basically, it's logging in your trades with all the parameters that are there in terms of your initial plan. What is your entry point, what is your stop loss, what is your expected profit level, and what is the basis on which you took this trade. These are the things that you should be recording in your trading journal, and that helps you to keep a track of what you're doing. Maintaining those records help you in your post analysis, and after having traded a few, you will need to track what triggered that trade and how many times did that trade succeed. So that builds a pattern of what is happening with your trades, and that's very important. So that's where it becomes important to post in your journals. As a special giveaway, I will add a link to a template which can be a start to what you can use to record your journal, record your trades. So it's important to maintain a journal, and it helps you in tracking your progress. So I think that is what you should be doing. So with this, we come to an end on our journey on the trading plan. These are the few things that you should be doing to get to at least initiate your trading in the right way. Success will depend on how well you follow your trading plan, and there'll be a system, and it will need a tweak once or twice, or maybe a number of times. But the point is that you need to be consistent in using the same plan every now and then, so that there's a consistency to what you do, and the result will be, if you boil down to a good pattern, and if you maintain that good pattern, your chances of being successful on your trades is going to be way larger. So it's time to wind up this subject, but I'd just like to remind you that I'm Manoj Maheshwari. I'm a certified technical analyst with an experience of over 8 years, and I'm here to help you with your trading journey. As a special giveaway, we have a channel where I place trades that I curate for myself and share it with people who would want to follow the trade leads that I follow. And it also gives me an opportunity to present the trade ideas and then go behind them and explain as to how the trade idea was curated in terms of what technical analysis points were used, and how I would analyze the outcome of that trade to have a high probability chance of giving us success. So every trade depends on probabilities. It's a game of probabilities, and you create an edge while taking the trade by trying to give it the maximum potential to make money. So if there are 10 things to consider, if 7 of them align, that's when your trade is called a high probability trade of it being successful. There's still no guarantee that the trade is not going to succeed, but it becomes a high probability trade. So I invite you to join my premium channel. I have a good success rate. You will get to see that for yourself if you join along. I have a website where I have a few courses. You could visit that website, and if you find any of these things lacking in your trading plan, or you want to know more about it, you can jump onto that course and subscribe to it. I am available on Twitter and when I see anything happening or I want to post a view or post an idea, I do go to Twitter to give it out in the world. So I'd like you to follow me. I have a YouTube channel too where I post a lot of my analysis on a weekly basis. I plan to give my view on how I see the markets. Can help you and give you a perspective. It may not be right, it may not turn out right, but gives you a perspective to consider. So do subscribe and like if you enjoy the effort that I put in. Thank you once again. I'm glad we had this time together and look forward to being with you again. Thank you.